All right, let's dive right in. On February 12, 2026, Dutch Bros dropped its fourth quarter earnings report, and believe me, this was one the entire street was waiting for. We're going to break down exactly what went down, because this report delivered a major surprise that really lit a fire into the stock.
So, the headline number. The company reported official GAAP earnings per share of 17 cents. Now on its own, that's a pretty solid number. But the real story here, the thing that gets interesting, isn't the number itself. It's how it stacks up against what everyone was expecting.
You see, the analyst consensus, the number everyone was watching, was for just 9 cents per share. So what we have here isn't just a little beat. No. This was a massive earnings beat. Dutch Bros basically doubled what the street thought they could do. That's a huge surprise, and it got everyone's attention immediately. And you know what happens when you surprise the market like that? The reaction is usually pretty quick and pretty powerful. And it was. The stock absolutely rocketed up, more than 13% in after-hours trading. This wasn't just a little pat on the back. This was an explosive move. It signaled that maybe, just maybe, the whole story around this company was about to change. And look, this wasn't just an earnings story. It was a clean sweep right across the board. Revenue crushed expectations by almost $19 million. Same-store sales, that's a super important metric for growth at existing shops, came in at a blistering 7.7%. And adjusted EBITDA, which is a good look at core profitability, just soared by 49% year over year. Literally every key metric was pointing straight up. So on the earnings call, CEO Christine Bearish was quick to frame this whole thing. She basically said, hey, this isn't a fluke. This is our strategy at work. She kept repeating that the company is a powerful growth engine and it's firing on all cylinders.
So, how are they doing it? Well, management calls it their growth algorithm. It's actually a pretty simple three-part playbook. First, scale the box, which just means open new shops as fast as you can. Second, protect traffic, so get more people coming through the line. And third, add new levers, like rolling out food, getting digital orders going, and trying out new store designs.
And you can see that algorithm playing out perfectly this quarter. They protected traffic with transaction growth of over 5%. They scaled the box, hitting record sales per store of $2.1 million. And they definitely added new levers. That food rollout is already adding a 4% lift to sales where they have it. And get this, they even proved out new formats, with their walk-up shop in LA becoming the #1 performer in the entire company. Okay, so a fantastic quarter, no doubt about it. But as investors, we always have to ask, what's next? And that brings us to the 2026 outlook, where the story gets, well, a little more interesting. Management came out with some really strong numbers for the year ahead. They're looking for revenue to cross that $2 billion mark. That's 22 to 24% growth. They're planning to open at least 181 new shops. And they think same-store sales will stay healthy at 3 to 5%. So yeah, the growth story is still pedal to the metal. But, and this is a big but, here's the core tension for investors in 2026. On one hand, you've got this incredible growth story. But on the other hand, management was very upfront about some challenges. They pointed directly to higher coffee costs hitting them in the first quarter and rising rent costs. So the big question is, can they balance this amazing top-line growth against these known pressures on their profit margins?
Now, to really get why this report was such a big deal, you have to understand the mood around the stock before the numbers came out. Let's just say the sentiment wasn't just neutral, it was really negative.
Just take a look at this chart. In the year leading up to this report, Dutch Bros stock was down a staggering 38%. At the same time, the wider consumer sector was up almost 6%, and the S&P 500 was up nearly 15%. BROS was getting left in the dust. It was a massive underperformer. So you can see why this quarter's huge beat and strong guidance wasn't just good news. It was a powerful and, frankly, a necessary reset to that whole bearish story. It basically forced the market to stop and completely rethink the company's future.
Which brings us to our final take here at Talk Tickers. Where does the stock go from here?
The key question every investor is asking right now is pretty simple. Can Dutch Bros keep this up? Can they sustain this momentum and really justify a full-on re-rating of the stock? Was this the start of a new trend, or was it just a one-hit wonder?
Well, to answer that, here are the key things we'll be watching in 2026. 1. Can they keep sales growing as that food program goes nationwide? 2. How well do they manage opening over 180 new shops, especially those Clutch Coffee locations they just bought? 3. Can they protect their profits from those higher coffee costs they warned us about? And finally, we need to see more proof that these new store formats, like that awesome LA walk-up, can really boost their returns.
So, what's the trade idea here? Well, we think you play for this momentum to continue. The idea is looking at long BROS calls heading into the next couple of earnings reports. We're targeting a potential move up towards that $70 level, making a bet that this operational strength is the real deal, and that the shift in sentiment from super bearish to bullish is just getting started. So, putting it all together, the strong execution, that clear growth algorithm, and the powerful narrative reset, our official rating on the stock is outperform.
And as always, our final reminder, this is not financial advice.